Let me tell you about one of the biggest mistakes I see traders make every single day, and it's costing them winning trades consistently. They treat volume profile levels like they're laser-precise lines. They sit there watching the screen, waiting for price to touch exactly on the level, not a tick above, not a tick below, perfectly on the number. And when price comes within a hair's breadth of their level but doesn't touch it exactly, they pass on the trade. Then they watch in complete frustration as price reverses right where they expected it to, hits the profit target perfectly, and they miss the entire move because they were too rigid about needing an exact touch. This is the wrong mindset, and I want to show you exactly what's happening here. Let me paint a picture of how this trader thinks. They're looking at their chart and they've identified that VAL, value area low, is exactly at 6515.25. In their mind, they've created this rule. Price must touch 6515.25 perfectly or the setup is invalid. They're insisting on perfect level touches with zero tolerance for deviation. So what happens? Price starts falling, comes down to 6515.50, just a quarter point away, which is literally 2 ticks on ES, and puts in a beautiful rejection candle. Strong lower wick, closes near the high, clear buyers stepping in. But this trader doesn't take it. Why? Because it didn't touch exactly 6515.25. It was 2 ticks away. That's not the level, they tell themselves. I need to wait for the exact touch. So they wait, and price reverses from 6515.50, rallies straight up to their target at 6518, and the entire move happens without them in the trade. They just missed a perfectly valid A-grade setup that came within 2 ticks of their level and showed clear reaction behavior. And here's the kicker. This happens repeatedly. They're missing setups that come within 2 to 3 ticks on ES or 4 to 6 ticks on NQ just because they're demanding laser precision that doesn't exist in real markets. They're ignoring clear price reactions just because price didn't touch their exact line. And the result? Massive frustration from watching almost setups work perfectly without them. They feel like the market is teasing them, like they can't catch a break. But the problem isn't the market. It's their mindset. Now, let me explain why this mindset is fundamentally flawed. Volume profile levels aren't exact price points. They're not laser lines. Let me explain how volume profiles are actually calculated. When you see VAL, value area low, at 6515.25, that number represents the bottom boundary of a zone where 70% of the session's volume traded. That's not a single price tick. It's the edge of a distribution. Volume distributes across multiple price levels, not just one precise print. Think about it this way. If 70% of volume traded in a range, the edges of that range are inherently fuzzy, not sharp. There's natural spillover above and below those calculated boundaries. Now, here's something else most traders don't consider. Different platforms and data feeds can show slightly different values for the same volume profile level. For instance, TradingView might show the VAL at 6515.25, while Sierra Chart shows it at 6515.00, and NinjaTrader might display it at 6515.50. Why is this? Well, it's due to minor differences in data feeds, rounding methods, and calculation algorithms. If the level were truly laser precise, every platform would display the exact same number down to the tick, but they don't, which proves that these levels are approximations of zones, not exact requirements. The correct mindset is a zone-based approach. Let me show you how professional traders think about volume profile levels. A seasoned trader looks at their chart and says the VAL zone ranges from 6515.00 to 6515.50. Any price approaching this area, accompanied by reaction behavior, counts as valid. They've shifted from a single-line mentality to a zone-based mentality. These traders accept a 2 to 3 tick buffer around the level for ES. For NQ, which is more volatile and has wider spreads, they extend that buffer to 4 to 6 ticks. This isn't sloppiness, it's realism about how markets actually work. They comprehend that volume distributes across prices, not single prints. So when VAL is calculated at 6515.25, there was significant volume at 6515.00, 6515.25, 6515.50, and everywhere in between. The entire zone matters, not just the specific calculated boundary. These professionals focus on reaction behavior, not exact touches. What matters is, does the price show a rejection when it enters this zone? Does it put in a strong wick? Does it close back inside the zone? These are the signs you're looking for, behavioral confirmations that the level is being respected, not whether it printed on your exact calculated number. And here's the payoff. This flexibility lets you capture more A-grade setups. By using zones instead of exact lines, you can take every valid setup that enters your buffer zone and shows a reaction. Your trade count goes up, your statistics improve, and your frustration goes way down because you're not missing trades over 1 or 2 ticks of difference.
Let's delve into the psychological aspects, because mindset shifts are just as crucial as technical understanding. When you start viewing levels as zones instead of exact lines, your trading stress significantly decreases. You're no longer anxiously watching the screen, wondering if the price will tick just one more time to hit your precise level. Instead, you're calm and prepared, knowing that as long as the price enters the zone and shows a reaction, you're on solid ground. This shift reduces the fear of missing out, or FOMO. You're not missing out on trades because of being excessively selective. By using zones, you can take every valid setup that meets your criteria, which improves your execution consistency. Moreover, it curbs revenge trading, because when you use zones properly, you avoid missing as many trades, reducing the emotional urge to chase entries. The key principle here is that if the price comes within 0.05% of the level and shows clear reaction behavior, that's close enough. For instance, on the ES at 65.15, 0.05% translates to about 3 ticks. On the NQ at 16,500, it means about 8 ticks. Embracing this tolerance isn't about being sloppy, it's realistic. Envision levels with halos as buffer zones, not as laser-precise lines. This is crucial because even the most experienced, consistently profitable traders use this mindset. They view volume profile levels as powerful tools to find high-probability zones, not exact points. Let's emphasize that this zone-based thinking applies to all levels: VAH, VAL, POC, high-volume nodes, and low-volume nodes. Consistency is key. Every level should have a buffer zone tailored to your trading instrument and time frame. You might ask how to ensure trades aren't too far from the level when using zones. Discipline with buffer width is the solution. For ES, a buffer of 2 to 3 ticks is ideal. For NQ, 4 to 6 ticks. Avoid letting your zones expand to 10 or 15 ticks just out of impatience. Here's a practical workflow. First, identify your volume profile level. Second, create a shaded rectangle around it with your buffer. Third, observe for reaction behavior when the price enters the zone. Fourth, if there's clear reaction within the zone, execute the trade. This approach also integrates with confluence stacking, which we'll explore later. Zone-based thinking helps you spot confluence more often by not waiting for perfect alignment of exact touches. Up next, we'll get into specific zone width guidelines, where I'll provide practical buffer ranges for different instruments and timeframes, equipping you with precise zone dimensions for ES, NQ, and other contracts you may trade.
All right, guys, so for this example, I will actually be using gold. Yes, gold, just to show you that it works on literally every asset that you want to trade in. So, like I said, guys, you don't have to treat these lines as like you must touch them, otherwise they don't count. Just look at them as zones. Let's see, like a range here. So here you can also measure how much you want it in terms of like pips, ticks, things like that. Now, this is really the easiest way to do it. It's to find an order block that's aligning with either your value area high, your point of control, or your value area low, or even a fair value gap. In this case here, what do we have? We have an order block. You can either use these two bearish candles or just this whole candle right here, but let's do it like this. And as you can see, price came down. Even though it did not touch my point of control perfectly, it still touched the order block. And what you could have done is find an entry setup and then take a trade targeting either this high right here or the value area high here, right? And then when price came down, what did price do? Tapped into the order block that was here. Now you can go from, okay, if you missed this setup here, now what you can do is find a re-entry using supply and demand. Price comes down, taps into this demand. Now you might say, wait a minute, that's too far away from the point of control. Don't worry. The reason why this is valid is because this area right here, right, this order block, this area in price, tapped into this order block here that is around the point of control, right? This is a point of control type of order block, I guess you could say. Price came down, tapped it, respected it very well, and then we started going up, came back down. Price is rejecting. As you can see, it's consolidating in the area, showing us that price does not plan on breaking through it very easily. And then you could have entered at this engulfing candle, and again targeted either this high or this value area high or this high point here, right? That is one example of how you can use them as zones. You can either measure it in ticks or in pips, or you can just find an order block that's near that point of control. Now, real quick, this is an example of what not to do, right? So as you can see, price was trying to come down this value area low, but pretty obvious, right, that it's not going to tap into it. So obviously you're not going to try going, oh, well, you know what, let me zone this whole area out to try to confirm my own biases, right? Obviously not. You want to be reasonable here. There's nothing, price is not near an order block here. So even if you were to mark out this area here, right, price is nowhere near it. So there'd be no point in trying to lie to yourself and saying, oh, well, let me see if I can just stretch this little order block out real quick. Maybe price will tap into it. Oh, look at that, it taps into it, right? No, don't do that, because that's gonna come and hurt you real bad. Okay, now a good example of what you could do is something right here. Okay, so this would be a supply here. Why? Because these two candles make an entire full candle on a higher time frame. Even ICT talks about this, so I'm not even making this up. And then this is also tapping into the value area high. Price comes up to it, taps it, and starts moving down, right? So that is a couple of ways that you guys should be looking at when it comes to the volume profiles, lines, right? How you can look at them as zones, okay? You don't have to just look at them as strict lines that price must tap into, otherwise it's not valid. Okay, there's obviously many more examples coming. I will try to keep trading with this. I will try to make a video only pure examples of trading with the volume profile, but for now, to keep the video as short as possible, you know, this is kind of like the main stuff here. Okay.
Zone width guidelines, practical buffer ranges for different instruments and timeframes. Let me explain something really important that most traders get wrong. They treat volume profile levels like they're exact, precise price points. They wait for price to touch exactly on the level, not a tick above, not a tick below, just right on the number. And you know what happens? They miss perfectly valid trades because price came within a hair's breadth of the level, but didn't touch it exactly. This is a huge mistake. and it costs traders money every single day. Here's the truth. Volume profile levels work best when you treat them as zones rather than precise lines. Think of it this way. If you're meeting a friend at a coffee shop at 2 p.m., and they show up at 1:58 or 2:02, did they show up on time? Of course they did. It's the same concept with trading levels. Price doesn't have to hit the exact tick to count as reaching the level. There's a natural buffer zone around these levels, and understanding these zones is absolutely critical to your success. Let me give you practical buffer ranges for different instruments and time frames. These are the guidelines I use, and they account for normal price fluctuation while maintaining setup validity. First, let's talk about the ES, which is the S&P 500 E-mini futures contract. When you're trading ES on a 1-minute time frame, you want to allow about 2 to 3 ticks around your volume profile levels. That's around VAH, which is value area high, VAL, which is value area low, and POC, which is point of control. Why 2 to 3 ticks? Because this accounts for normal price oscillation and wicking behavior near volume levels. Price naturally bounces around a little bit. If you demand an exact touch, you're going to miss trades where price came within 2 ticks of your level, respected it perfectly, and then moved in your direction. Now, let's move to NQ, which is the NASDAQ 100 E-mini futures. NQ is a different animal than ES. It's more volatile, it moves faster, and it has wider spreads. Because of this, you need a larger buffer zone. For NQ on a 1-minute time frame, use a buffer of about 4 to 6 ticks around your volume profile levels. Why wider? Because NQ has higher volatility and wider spreads. If you try to use the same 2 to 3 tick buffer that works for ES, you're going to get faked out constantly. Think of it like this. If ES is a calm lake, NQ is a choppy ocean. You need more room to work with. Here's another critical point that most traders don't consider. Weekly levels versus daily or session levels. You need to allow a wider halo, a bigger buffer zone, for weekly levels compared to daily or session levels. Why? Because higher time frame levels have more gravitational pull over broader price ranges. A weekly POC, or weekly VAH, is a much more significant level than a daily POC. It's been built over 5 trading days, with way more volume, and it represents a much more important consensus price. Because of that, price can approach these weekly levels from a wider range and still count as a valid touch. Now, here's a pro tip that will save you a lot of frustration. Use shaded zone boxes on your charts to visualize these acceptable touch areas. Most charting platforms, TradingView, Sierra Chart, NinjaTrader, let you draw rectangles or shaded boxes. Instead of just drawing a single horizontal line at your volume profile level, draw a shaded box that covers the buffer zone. This prevents you from obsessing over exact price matches and helps you recognize valid near touches that count as A setups. Let me emphasize the psychological aspect here. When you start using zones instead of exact lines, your trading stress goes way down. You're not sitting there with your heart racing, hoping price comes exactly to your level. You're calm and prepared, knowing that as long as price enters the zone, you're good to go. This reduces FOMO, fear of missing out, and it reduces revenge trading. One more thing, don't make your zones too wide. If you're trading ES and you're using a 10-tick buffer, that's way too loose. You'll end up taking trades that are nowhere near the actual level, and your win rate will suffer. Stick to the guidelines. 2 to 3 ticks for ES, 4 to 6 for NQ, and slightly wider for weekly levels. And remember, these zone widths apply specifically to 1-minute intraday trading. If you're trading higher time frames, like 5-minute or 15-minute charts, you might adjust slightly, but the principle stays the same. Levels are zones. Allow for natural price fluctuation. Don't demand perfection. To summarize, stop demanding exact touches. Use shaded zone boxes. Understand the buffer ranges for your instrument, and recognize that valid near touches count as A setups. Next, we'll cover stop-loss mastery, how to cover the level with room to survive retests, and avoid getting prematurely stopped out of winning trades. Stop-loss mastery. Cover the level with room. Proper stop placement is the difference between surviving retests and getting prematurely stopped out of winning trades. Let me explain the core principles that will protect your capital and keep you in winning trades. The core principle: stops should survive a double tap of the zone. Don't place your stop directly on the level. Place it beyond the zone, with breathing room behind nearby structure. Let me break down the 4 key principles. First, survive the double tap. Volume profile levels aren't exact price points. They're zones. Price often retests these zones before moving in your direction. Your stop must survive these retests. If you place your stop too tight, you'll get stopped out on the first retest, miss the actual move, and feel frustrated watching the trade work without you. Second, don't place stop on the level. Placing your stop directly at VAH, VAL, or POC is asking to get wicked out. The level needs room to breathe. Stops placed exactly on levels get hunted constantly. Market makers and algorithms know where retail traders place their stops, and they'll push price just far enough to trigger those stops before reversing. Third, place beyond zone plus behind structure. Identify the nearest swing high or low that contains the zone. Then place your stop beyond that structure. This gives the trade room while still defining clear invalidation. You're not giving the trade unlimited room. You're using logical market structure to define where you're wrong. Fourth, think in zones. Use structure. Levels are zones, not laser lines. Use nearby market structure, swings, consolidation edges to protect your stop while accounting for typical level behavior. This approach balances protection with realism. Now, let's talk about the double tap test. This is your mental checklist before every trade. Ask yourself, if price comes back to tap this level twice, will my stop survive? If the answer is no, move it wider. Here's your practical checklist. Stop beyond the zone. 2 to 3 ticks for ES, 4 to 6 for NQ. Stop behind recent swing that contains the level. Account for typical retest behavior. For A setups, slightly tighter since they're trend-aligned and less likely to retest. For B setups, wider to anticipate confirmation retest. Let me emphasize the psychology here. Proper stop placement dramatically reduces the frustration of being right but stopped out. When your stops survive natural retests, you stay in winning trades longer and avoid the emotional damage of unnecessary losses. This builds confidence and trust in your strategy. You start trusting your system because you're not getting stopped out on noise. You're only getting stopped out when you're actually wrong. Now, I'm going to show you live examples on the charts to demonstrate exactly how to apply these stop-loss principles in real trading scenarios. Watch carefully as I walk through the process of identifying structure, placing stops beyond zones, and using the double tap test in live market conditions. Next, we'll cover structure and the double tap test in more detail, a systematic workflow to place stops that survive retests.
Okay, so for this example, we will be using copper futures. Now, this is probably the best example you will ever find here. Why? Because not only are we seeing that we can be using, you know what, give me a second. Okay, we can be using the value area low or these volume profile lines just to make it easier for you guys to understand. We can use them as zones, right? Like I was saying earlier. Well, as you can see here, price tapped into that zone and then started rallying up. Now let's just say you are trading, right? You entered around I don't know, let's just say you just put the limit order here. I'm not saying that you should be trading with limit orders, but you can. Now let's just say you were being a little greedy and you wanted to target this high right here, right? Let's say that's what you wanted. But you said, you know what? I'm going to put my stop right at the VAL, value area low. You put your stop here. Price is going up, still hasn't hit your TP. Next thing you know, price reverses, comes in for a second tap. This is what I would consider the first tap. This is the second tap. Now you could also say you tapped into it here the first time, and then this was the second tap, and then this was the third tap. However you want to see it, I don't care, right? But what we do know is that this area was retested twice. And if you had your stop loss right at that value area low, you would have been cooked, right? But if you would have put it at this low here, right, this small structural point, you would have been good to go, right? And once price tested that area again, guess what happened? Price started rallying back up, right? Rejected really well, finally hitting your take profit, right? That is how you guys should be trading, right? Using structure as well as part of your stop loss. Don't just use the value area lows or value area highs or point of controls as your stopping point. These lines, guys, these profile lines are best for targeting, not so much for setting your stop losses. And if you're going to use them for entries, again, look at them as zones. Okay, so with that being said, let's move on.
Structure plus the double tap test. Now let me give you a systematic workflow to place stops that survive retests while protecting against true invalidation. This is the practical application of everything we've covered so far about stop loss mastery. Stop loss placement workflow. Here's your 3-step process. Step 1. Mark the zone. Convert your level from a line to a band. VAL, VAH, and POC become zones with a 2 to 3 tick buffer, not exact prices. This is where we shift from laser line thinking to zone-based thinking. Your level isn't a single price, it's a range. Step 2. Identify swing structure. Find the nearest swing high or low beyond the zone that contains the level and gives breathing room. This is where you're looking at the actual market structure, the recent highs and lows that define where price has been rejected before. You're identifying the swing that wraps around your zone and provides natural protection. Step 3. Place stop beyond. Your stop goes past that swing to survive the double tap. The level can retest twice without stopping you out. This is the critical part. You're not placing your stop on the level, not on the edge of the zone, but beyond the structure that contains the zone. This ensures that even if price comes back and tests the level twice, your stop survives, and you stay in the trade. Now, let's talk about how this workflow differs between A setups and B setups. A setup stop placement, slightly tighter stops. Why? Because A setups are trend aligned, which means there's less retest risk. Price is more likely to move in your direction immediately, so you place your stop just beyond the nearest swing that covers the zone. You're confident in directional follow-through, so you don't need as much room. B setup stop placement, wider stops required. Why? Because B setups are trend against or neutral, which means there's higher retest probability. Price might come back to test the level again before moving in your direction. So you place your stop further beyond the zone, anticipating a confirmation move back to the level before continuation. This gives the trade more room to breathe and prevents you from getting stopped out on normal retest behavior. The key principle here is adaptation. You're not using the same stop placement for every trade. You're adjusting based on setup grade, trend alignment, and retest probability. A setups get tighter stops because they're higher probability. B setups get wider stops because you're giving price more room to confirm. Next up, we'll dive into target selection hierarchy. a simple, consistent framework for choosing profit targets that match your setup grade and market conditions.
Let me show you a simple, consistent framework for choosing profit targets. This is going to make your targeting decisions much easier and more systematic. The key is to use this three-tier hierarchy. Start with the simplest approach, level 1, and move down only when needed. Don't overcomplicate this. Level 1, nearest structure in trend direction. This is your default method. You'll use this about 80% of the time. Target the most recent swing high for longs or swing low for shorts in the direction of your trade. This is your primary targeting method because it's simple, visible, and based on actual market structure. It works for the vast majority of setups. When you see clear structure within 5 to 10 points in your trade direction, this is what you use. Level 2, nearest volume profile level. This is your alternate method. You'll use this about 15% of the time. When structure isn't obvious or when it aligns with a volume profile level, target the nearest HVN, POC, VAH, or VAL. Volume levels act as magnets and they often align with structure anyway. Use this when level 1 and level 2 converge. That's a high confidence target. If structure is unclear but there's a volume level nearby, go with level 2. Level 3, fixed risk reward. This is your fallback method. You'll only use this about 5% of the time. When neither structure nor volume levels provide clear guidance, use a fixed risk-reward ratio of 1.5 to 1 or 2 to 1. This is your emergency fallback for uncertain market conditions, but prefer levels 1 and 2 whenever possible because they're based on actual market logic, not arbitrary math. Here's the critical rule. Plan before entry. Know your target before you execute. Consistency in target selection builds edge over time. Don't enter a trade and then figure out where you're going to exit. That's backwards. You need to know your complete trade plan, entry, stop, and target before you risk a single dollar. Let me give you a quick decision guide. Ask yourself, is there obvious structure within 5 to 10 points? If yes, use level 1. If structure is unclear but there's a volume level nearby, use level 2. If neither is clear, use level 3 with a 1.5 to 2R target. And if structure and a volume level align, that's a high confidence target. Take it. Next, we'll walk through a decision tree that gives you a simple workflow to determine your take profit target step by step. Let's walk through a simple workflow to determine your take profit targets based on available structure and levels. This is a decision tree you'll use with every single trade. Start with question 1. Is there obvious structure in the trend direction within about 10 points? If yes, target the structure. This is your default approach, and you'll use it about 80% of the time. You're targeting the nearest swing high for longs or swing low for shorts in the direction of your trade. This method is clean, simple, and objective. If no, meaning structure isn't obvious or clear, move to question 2. Is there a nearby volume profile level, HVN, POC, VAH, or VAL? If yes to question 2, target the VP level. This alternate approach is used about 15% of the time, as volume profile levels act as magnets where price seeks equilibrium. If no to question 2, use fixed risk-reward ratios. This fallback approach is used about 5% of the time when no clear structure or levels are available. Remember, the key is following the hierarchy in order. Always check for structure first. If structure isn't clear, check for volume profile levels. Only if both are unclear do you fall back to fixed risk-reward. Next up, I'll show you live examples that combine structure and volume profile levels to provide high-confidence targets with maximum clarity.
All right, so starting with example 1. So we've actually got US 30 here on the chart. So as you can see, price is actually reacting really well off of this level here, right, as we already know. And price is also reacting really well from that fair value gap, obviously. So now let's say you are entering a trade, right? You're entering a short position from that imbalance. Perfect, cool. Now, why would I not just target this low right here, right? This value area low. Well, sometimes if you're trading prop firms, you have to close your trades before 5 o'clock, right? 5 p.m. Eastern time. And as you can see here, it is about to be 5 o'clock here, right? And you would have been closed out automatically, or some prop firms will fail you. Some prop firms will not close you out, and they might or might not be okay. It just depends on their rules. But just to be safe, let's just say you're trading with a really strict prop firm. So that means you want to target the nearest area of market structure that you can, but that's also going to give you a good bit of money, right? A good bit of returns. So here you can have this as your area of target, right? And if you are allowed to target at this point of control, I mean the value area low, excuse me, then go ahead, go for it. But it would be smarter for you to just target this area here, especially if you're under that time constraint. And as you can see, right, it's a higher probability chance of being targeted because you're already rejecting from the value area high. It's already rejecting from the point of control as well. This also aligns near a high volume node, right? As you can see here, it's near that area. So it's obvious that price is also going to tap into this low, right? This very immediate low. So that is one example, right, of targeting clear market structure. It's very, very simple, guys. Nothing crazy. Okay, so for this example, we are going to be using the volume levels from the weekly, and we're also going to be using the daily. Now, let's just say you're not very familiar with a lot of the ICT concepts or SMT concepts, whatever the case may be, right? Let's just say you don't see this breaker block as valid, or you just didn't notice it, whatever the case may be. Well, in this particular example, since we do have the daily's value area high, right, this one right here, we can also see that it's overlapping with the weekly point of control. So as you can see, price is coming up, it's rejecting off of it. It's pretty obvious that price rejected really quickly, because we are on the 1 minute time frame, by the way. It's rejecting pretty aggressively, breaking structure towards the downside. So let's just say you aren't under a time window constraint and you're actually willing to target one of these volume profiles lines. So let's just say you're only basing your trades off of volume profile levels. You see that price is rejecting off of the daily's volume area high and the weekly's point of control, right? Let's just say you decide to enter right here. You can put your stop loss either at the high right here or a few pips above it, just to be safe. And now for your target, we can actually target the weekly's value area low, right? I have them labeled right here. It's the purple one. And so why would I target the weekly's value area low as opposed to targeting the daily's point of control? Well, the answer really is just depends on you, right? In this case, this weekly value area low is only a couple of pips lower, right? So it's not that much of a huge difference, but it can be the difference between, depending on your lot size, maybe making 200 extra bucks, right? Or maybe even 500 extra bucks. All I know is that I want to make as much money as possible. And since these levels are almost overlapping, it's very high likelihood that it's going to get targeted. And as you can see, guys, as soon as price touched that weekly value area low, right? Look how strongly it started rejecting off of it almost perfectly, right? What better area to target? Now, obviously, if this was way, way lower, depending on the context, I may or may not target it. But point is you can use either one. You can use either the weekly's volume profile levels, the dailies, and sometimes even the monthly. Again, it all depends on the context of what you're seeing in the market, okay? But yes, you can target these areas. Okay, so for this example, I am on GBP JPY. And by the way, guys, so most of these examples have been on the 1 minute time frame unless I specifically say otherwise. So for the most part, if I don't mention the time frame, most of these entries and trades are on that 1 minute time frame. So as you can see here, guys, let's just say you're a little bit confused, right? Now you might say, well, there's liquidity here, and then it's possible that this area might be an area of liquidity as well for price, but price isn't really giving much of a solid direction, right? It's been going up, maybe breaking some structure towards the upside, but also breaking some towards the downside. So you're not too sure. And let's just say it's already kind of late during the trading day, right? It's around, let's see, 3 something, right? 3:30, let's say. And you want to get in a quick trade, but you're not too sure where to target, right? Let's just say that you are not too sure because, well, to be honest, this could also be an area, right, where that price targets. Let's see here, right? Or it could be this area that price might want to target, right? The value area high. We don't know. And considering that market has been taking out liquidity on both sides, and it's kind of been, well, directionless, it's kind of hard to say. So the safest thing to do, if you have to absolutely enter a trade, the best thing to do is to go for a fixed risk to reward. Now, typically I've seen most people go for a 2R. So in this example, that's what I'll be using. And considering that this is the nearest fractal high that I could find with a good bit of risk to reward, I thought if it overlaps, then great. But if it doesn't, that's all right. Now, let's just say that you didn't see this. You could still go for that 2R. This liquidity gets swept. Price taps into the value area low. Okay. I see a very, very small change in state of delivery here, right? I enter off of that candle closure, and then I just go for a strict 2R stops just a little bit below this low here, right? That recent low, maybe a few pips low if I want to, but for now it's more than okay. Strict 2R, TP gets hit, right? And then what does price do? Immediately reverse. Now if you're starting off, I would recommend going for like maybe like a 1 to 2, or then maybe a 1 to 5. And if you really want to go for it, then yeah, go for that 2R. Okay, but it's up to you guys. Back test these things. Don't just do this blindly. Okay, please back test this stuff. Now again, there's way many more ways to trade, but these are just a couple of examples that I wanted to give you.
Welcome to this insightful session on one of the most powerful concepts in volume profile trading, confluence stacking. Confluence stacking involves identifying multiple independent confirmations at a single price level, dramatically enhancing your setup quality and success probability. Let's start by defining confluence. Confluence occurs when multiple independent reasons converge at the same place and time. When differing analytical frameworks point to the same level, your trading edge multiplies significantly. The emphasis here is on independent. Each factor should arise from different data or logic, not merely variations of the same idea. Why does confluence matter so much? Even though single-factor trades can be profitable, adding confluence significantly boosts your hit rate, enabling larger position sizes within your risk parameters. It's not about trading more, it's about trading better when the conditions are right. Here are 3 common types of confluence you'll frequently encounter. First, multi-level alignment, where different time frame levels like weekly POC and daily VAL converge at one price zone. Second, multi-time frame volume profile, confirming higher time frame structure with lower time frame structure for powerful confirmation. Third, developing volume plus prior levels, where real-time volume confirms historical price interest, validating old levels with fresh market activity. Here's a practical framework you should adopt: confluence ranking. Count your independent factors. 3 or more confluences mean an exceptional setup where aggressive positioning is viable. 2 confluences offer a strong setup, while 1 factor calls for caution. The principle is clear. The more independent confluences at a level, the more aggressive you can be. Fewer confluences warrant more caution or waiting for further confirmation. This isn't about being picky, it's about understanding probability and optimizing capital allocation for the highest edge. Track which combinations best fit your trading style and recognize patterns that resonate with your decision-making or yield better results.
Alright guys, so for this next example, I will show you how to use proper top-down analysis in terms of using the weekly volume levels and the current session or daily volume levels. Alright, so here's how you have to draw them first. Remember, you have to be on the 1 minute, okay? You have to be on the 1 minute. And what you're going to do is you can either use the fixed volume profile and draw it up manually, or you can use an indicator right now. So you're going to start from the Friday 4:59 p.m. time, okay? Or the minute before the close of Friday. Then from there, you're going to drag it back all the way to that week's Sunday open. So it's Monday, we gotta go back. Okay, so we got that right. So around, give me a second, I'm trying to get it at the 6, there you go, from 6. All right, so as you can see here, we have that previous trading week's volume profile levels, right? So what you can also do is you can, if you're having problems trying to figure out like the exact time, I will share an indicator that I made. It was based off of another precision indicator, but I ended up making a few tweaks. I'll share it down in the description below. But yeah, it highlights like the weekly and the daily and even hour session. Here's a quick look at it. Yeah, so this is how it would look like. You guys can customize all that. So after you have this drawn, okay, now I forgot to show you guys this. I had this on. I was supposed to keep it off, but it's okay. I turned it off, but if I had it on, that's why it looks so weird, right? But I have to keep it off. So that's why it would look normal now. So that's actually a good thing that I had it on, so that way you guys can double check to make sure that when you are using the previous week's volume profile levels to have that off, okay? It's very, very important that you have that off. So what you will do is mark those or use those levels, okay? You're gonna have to mark them here. Try to get it as accurate as possible. Okay, so finally I got them marked correctly here. So I labeled them right. This is the settings that you guys can copy right here, right? The colors, all that stuff. So that's how it should look. And then after you do that, you can either get rid of it or you can keep it on. It's up to you, but that is how you would mark them. And keep in mind, guys, if you start switching from like different time frames, the reason why you want to always mark them down on the 1 minute, this is actually another reason, is because if you start going to switch to different time frames, these levels can like slightly change. So at least if you have them marked down on the 1 minute, you have them as accurate as possible. But even though they don't change that much, it's still always best to have them like that, okay? That's another reason why it's very, very important that you mark it all on the 1 minute. And even if you are using an indicator to mark up the previous week's volume profiles, I would still highly recommend that you do this, okay? Just to be safe, all right? But yeah, there are indicators that can help. And the other problem too is if you're using an indicator, sometimes they're only allowed to read a certain amount of candlestick bars, so you might encounter problems there. So just do it this way, guys. It's much more efficient. All right, so I actually decided to go more into a little bit deeper how to draw the different types of profile levels, just so you guys can have a better understanding, and then I'll move on to the actual examples themselves. So for this one, I'm going to show you how to draw the previous day's profile. So here, what you will do is you can get the fixed range volume profile, and let's say you're going to start trading the Thursday session. You can use the previous day's profile to literally trade any session in the next trading day. So if you're trading the Asia session, you can use the previous day's levels. If you're trading London, New York, you will always rely on the previous day's levels. So what levels are these? So it's actually from 4 p.m., right? Remember, on the 1 minute, and then we go back all the way to the 9:30 a.m. and this is all Eastern Standard Time. Okay, so that's how it should look like. And if you're wondering what colors I'm using, these are the settings, but these are the colors themselves. This right here, same thing here. So yeah, then what you want to do is, like I told you guys last time, you want to draw them manually. Okay, so that's how they would look like, right? PDVAH, PDPOC, then PDVAL. And then if you want, you can just get rid of this, or you can just leave it on there. And yeah, you would essentially use this to trade all the way up till the end of that next day session, which would be 4 p.m. And then you would essentially do the same thing, right? Start from 4 p.m. all the way back to 9:30 a.m. and then continue trading on the next trading session after that one. Now, some of you guys might be wondering, well, what if I have to trade on Monday? Well, no problem. Simply draw it up from Friday, right? Friday's open and close. So you will go from 9:30 a.m. to the close, or the 4 p.m. Let me see if I can get it here. Okay, yeah, so 9:30 a.m. to 4 p.m. All right. And now all we have to do is add our lines. Okay, so we have our point of control line, our value area high, and then our value area low. And then we just continue trading that on throughout the entire session, right? And then once the session ends, then you will use Monday's levels to trade Tuesday's levels, right? So that is how you would draw the previous day's volume profile levels. Okay, so I'm going to show you how to draw the overnight volume profile on the chart. So remember, guys, you can use all these different profiles individually. You can pair them up together with different types of volume profiles. You can put them all together if you want once you get really comfortable with them, but that's just a little unnecessary if I'm being honest. But there's many ways you can combine them if you want. And another thing too is that I will be sharing like some Reddit links that you guys could check the description down below, and that'll basically give you some instructions on how to set these up in case you forget, and in case you don't want to find the video, have to freaking look for it again. You could just bookmark it and save it for yourselves. So the way you want to draw this is you want to start from the 9:30 a.m. of the previous day. So in this case, we will be using Wednesday because we will be trading on Thursday. And then from there, you're going to draw it all the way back to 6 p.m., right? And then once you have that, you can now add your levels here. Okay, as you can see, these are the levels extended out. And remember, this is all on the 1 minute time frame. And then you can use these levels to trade the entire next day, right? So if you're a New York session trader, you can use these levels. If you are an overnight session trader, you can trade those. If you're a London trader, you can also use these levels to trade that session as well, right? And then once that session or that day has ended, then all you will do is repeat the same process, right? Look for the 6 p.m., right? 6 p.m. close all the way to the 9:30 a.m. candle, and then use those levels from that previous day to trade the next day, right? Really easy, really simple. Okay guys, so this is how it will look on the Reddit links that I will put in the description down below. So when it comes to the current session's profile. For all of you overnight/London traders, you will draw it from 6 p.m. to the current time of the trading session that you are in. And for all of you New York session traders, it will start from 9:30 a.m. to the current time of the trading session that you are in. Okay, so there are two ways that you can actually mark it. You can actually use this indicator that I will share with you guys. Just copy the settings here, make sure it's on custom style. You can copy the style if you want, it's up to you. And essentially you can have it on and it'll develop, I would say, exactly as what the fixed ranged volume profile would as well. There we go. So obviously, again, guys, when using developing volume profile, make sure it says extended right. Otherwise, it will not develop with the trend. Okay. Always make sure you have that on, because as you guys noticed, when I had it off, it didn't do anything, right? But as soon as I turned it back on, right, it's developing with the session. So those are two ways that you guys can use or set up the current volume profile session. Now, this is mainly meant for finding your entries, right? If you're trying to enter into a trade, this is mainly what it's used for. I wouldn't say you should use the current volume profile for finding long-term trade direction. This is just mainly for trying to find the highest, like let's say volumized order block, or if you find a fair value gap that has a ton of volume and it happens to overlap with one of those volume levels, then that would be a time to enter a trade. But that is how you would essentially set it up. And yeah, it's not that difficult, guys. It's pretty easy. Okay, guys, so in this example, we will be using the developing market profile here, and we will be also using the previous week's volume levels. So real quick, let me show you how I have it all marked out. So I marked it out from last week's, right? Let's see here, last week's Friday close. Yep, Friday's close all the way back here till Sunday's open, right? And then, as you guys know, we mark them out physically, right? And then we're using the previous week's levels, or basically extending the previous week's levels to the current week that we're trading in. Now, we have the developing volume profile, right? Here's the settings: row size 1000, volume area 70, and remember, extend right. Okay, so now obviously this is all in hindsight, but there's a lot we have to break down here. So as you can see, we have the point of control here, the value area high, and then the value area low. Now, if you guys notice, we also have some high volume nodes right here and right here. So let's say you started off at the 9:30 a.m. open, right? And let's say you wanted to trade the PM sessions, or one of the PM sessions, or a macro session, whatever the case may be. You see this big move towards the upside. What do you notice? You notice that it's reacting off of one of the volumes profiles levels, which is the value area low. And there's also a high volume node here. What else do you see? We also see this very small order block, right? So you have three confluences here, hence why it's giving us this reaction. Now, let's just say that you're not taking any market structure into account, right? At least not from the previous days. You're just using the current levels, which you should be taking into account previous market structure. But let's just say you missed this trade. So now you want to wait for another re-entry. So what would price more than likely do? It would probably retrace back into the point of control, right? So we got to be patient. Now, remember, guys, think of these levels as zones, not as support and resistance levels that must be touched, otherwise they don't count. Remember, we already went through this. It's not like that at all. We wait. You could have entered here, right? Somewhere here. Maybe you're on this breaker block here. Or if you missed it and you're waiting for another entry, give it a second. As we're waiting as well for these levels to adjust, you can also adjust your entry as well, right? So notice how these levels are adjusting. Bam, taps into the value area high, and it's still bearish. Okay, all right, nice. So we're back again near the previous week's point of control. We also have the current volume profile point of control here, right? This is the one developing. Let me color code it for you guys a little bit better here. All right, so it's near the current session's point of control, and it's also right near the previous week's point of control as well. And again, here is that breaker block here, really nice level. And what do we see here? Two very strong bullish candles towards the upside, right? So there were many places where we could have entered. Remember, one right here, right, an entry here, the other entry was here. Price came down, started coming down after it tapped into the previous week's value area high. Price started rejecting, right? Failed to make another higher high, started coming down. We didn't see any strong bullish momentum towards the upside, so we're gonna keep waiting. And then once price tapped into this level again, near the previous week's point of control, as well as near the current session's volume profile's point of control, and then we see these bullish engulfing candles, why wouldn't you take that trade, right? So we would be targeting this high right here, okay? So now all we'll do is let price play out, bam, take profit just like that. So something else that you guys got to keep in mind, right, that these value areas can turn from support to resistance, and then from resistance to support, right? But now you know how you can actually combine the previous week's points of control, points of volume, points of value area highs and value area lows, and you can pair it up with the fixed volume profile for the developing day. All right, it's not that hard. It's pretty easy, guys. Obviously, there's more advanced ways to do it, but this is just a way that you guys can also get started and also play around and start back testing with as well.
Let me walk you through 5 high-probability confluence patterns that represent some of the absolute best trade setups in volume profile trading. These are scenarios where multiple independent factors align at a single level, significantly increasing your setup quality and win probability. But before we dive in, I want to make something crystal clear. These 5 confluences are not set in stone. They're not the only confluences that work. Think of them as proven templates, patterns that have consistently shown edge across thousands of trades. However, every trader is different. Your schedule, your risk tolerance, your preferred session times, and your psychological makeup all influence which confluences will work best for you. So as we go through these 5 patterns, I want you to see them as a starting point, not the finish line. You can and should develop your own custom confluences based on your backtesting, your observations, and what resonates with your trading style. The key is rigorous testing. Don't just invent a confluence and start trading it with real money. Backtest it, forward test it on paper, log the results, and refine it. Only then should you trust it with your capital. Now, let's break down these 5 patterns in detail. Confluence number 1, PWPOC plus PDVAL plus bullish trend. This is a multi-time frame support alignment pattern. Here's what's happening. Previous week point of control, which you've marked in orange on your chart, aligns perfectly with previous day value area low, marked in white. And critically, your 1-minute trend is bullish. Let me explain why this is so powerful. The previous week POC represents where the highest volume traded over the entire week. That's 5 full trading sessions of participants agreeing that this price level represents fair value. It's a major consensus level, a magnet where price seeks equilibrium. Now, the previous day VAL is the bottom of yesterday's value area, the floor of where 70% of yesterday's volume traded. It represents support from the most recent session, which market participants still remember vividly. When these 2 levels converge, when weekly structure and daily structure agree on the same price zone, you've got layered confirmation. But here's the multiplier. Your 1-minute trend is bullish. That means momentum is already aligned with your directional bias. You're not fighting the current, you're swimming with it. This is an A-grade aggressive entry setup. You have multi-time frame support, which is structural confirmation, plus momentum confirmation from the current trend. The probability of this level holding and price bouncing higher is exceptionally high. When you spot this pattern, you can size more aggressively within your risk parameters because you got 3 independent confirmations all pointing in the same direction. Confluence number 2, PDVAH plus HVN plus rejection wick. This is a double resistance short setup with behavioral confirmation. Here's the breakdown. Previous day value area high meets a high volume node, and you see a strong upper wick rejection candle right at that convergence. Let me unpack why this is a high probability short. Previous day VAH is the ceiling of yesterday's value area. It's where buyers stopped accepting higher prices and sellers started gaining control. It's recent resistance, and the market remembers it. Now, a high volume node, or HVN, is a price level where historically a lot of volume has traded. It's an area of past acceptance and equilibrium. But here's the key. When price approaches an HVN from below and tries to push through it, it often gets rejected because there's so much historical supply sitting at that level. So you've got double resistance, the structural ceiling from yesterday's value area, and the volume-based supply zone from historical trading. But it gets better. You see a strong upper wick rejection candle. That wick is behavioral evidence. It's proof that sellers are actively defending that level right now in real time. Buyers tried to push higher, got rejected hard, and price closed near the low of that candle. That's seller dominance showing up on the chart. When you combine structural resistance, volume-based supply, and real-time rejection behavior, you've got a textbook short setup. This is where you fade the resistance with confidence, targeting a move back down toward support. Confluence number 3, overnight VAL plus session POC shift. This is a magnet effect pattern with real-time developing volume confirmation. Here's what's happening. Overnight VAL, which you've marked in blue on your chart, aligns with your current session POC shifting toward that level. Let me explain the mechanics. The overnight VAL represents the bottom of the value area during the overnight session, the Asian and European hours from about 6 p.m. to 9:30 a.m. Eastern Time. It's the support level where overnight participants found equilibrium. Now, here's where it gets interesting. Your current session POC is shifting toward that overnight level. The POC, remember, is the price level where the most volume is trading right now in the current session. When the POC starts migrating toward a prior level, that's the market telling you in real time that the participants are gravitating toward that price. It's a magnet effect. Think of it this way. The overnight session left a footprint saying this price zone matters, and now, during the regular trading hours, the volume is confirming that same level. You're seeing developing value converge with prior structure. This is real-time confluence, not just historical alignment, but the current market validating a past level. When you spot this pattern, you know the level isn't just theoretical, it's actively being respected right now. That makes it a high-confidence entry point, because the market is showing its hand in real time. Next segment will cover confluences 4 and 5 plus customization guidance. Confluence number 4, LVN plus break and hold plus pullback. This is a momentum continuation setup based on structural confirmation with low volume nodes, or LVNs. Now, let me explain why this setup is so powerful. An LVN is a price zone with very little historical trade volume, appearing as a gap or thin area on your volume profile histogram. Think of it like a weak layer in the market structure, a zone of minimal support or resistance due to lack of consensus. When a low volume node is decisively broken, we're looking at price pushing through this thin volume area with conviction, closing fully beyond the LVN. This break indicates strength and momentum from one side of the market. Critically, price should hold above the LVN for longs or below for shorts, proving that the break isn't a fake out and that there's genuine market strength behind the move. After holding, a pullback fills the LVN gap, offering an entry opportunity. This setup works because LVNs, once broken, offer little resistance, and the hold proves true conviction. The pullback represents profit-taking, not reversal, and the unfilled gap acts like a vacuum, encouraging quick price movement. Combining a structural break, a behavioral hold, and an entry pullback gives 3 confirmations for a high-probability trade. Confluence number 5, VAH flip to support plus impulse. Here we have a role reversal pattern confirmed by momentum. When previous resistance, specifically the value area high, becomes support, and you observe a strong impulse candle moving away, it's significant. The structural logic behind this is that old resistance becomes new support after a break. The impulse candle confirms this role reversal, providing both structural logic and behavioral proof. Now, as we wrap up these confluences, I want to emphasize they're templates proven over time, but not the only ones that exist. Customize your approach by rigorously testing your confluences through historical chart analysis and simulation. Track your results and tailor strategies to your preferences. Next, we'll shift focus to session-specific playbooks, exploring tailored trading strategies for London, New York, and Asian sessions, considering their unique characteristics.
All right, so something I actually want to clarify real quick, and this is about drawing the previous day's levels. So I know that some of you guys are probably going to have questions about this, so I need to definitely straighten this out. So there are, I guess you could say, two ways of drawing it. The way that I like drawing them and the one that I'm usually always referring to are the levels that are drawn from the 9:30 a.m. New York trading session all the way up till 4 p.m. right? Now, there are people, for them, what they mean by previous day's levels, they mean the entire previous day or trading day, right? Using the time of the daily candle. So it would be from 6 p.m. all the way to 4:59 p.m. and this is all on the 1 minute time frame. So you guys can actually trade based off of those levels as well, right? From this previous day's levels, but typically I do prefer just using the profile that is drawn from 9:30 a.m. all the way to 4 p.m. just because to me these levels are more significant, since this is the time that most traders, banks, etc. trade through, right? This is the time window that we all know that most people trade in. But you can formulate strategies around the entire previous day's levels. Now, there are times when I will refer to this as an example, and I'll try to let you guys know. Sometimes I do forget, but for the most part, from what I remember, I have been using this one right here, okay? The regular trading hours fixed range volume profile, right? From 9:30 a.m. till 4 p.m. But yeah, I thought I should clarify that for you guys. You guys can use either one, whatever you like. Just make sure you're back testing it. Okay? All right, cool.